All right, we're up again after the 50th record high of the year on Friday. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, the Trump trade still going strong. U.S. equity futures gain after their best weekly performance of the year following Donald Trump's election victory.
Cryptocurrencies are no exception to the risk-on rally. In fact, probably leading the charge. Bitcoin soars as Trump's decisive win boosts pro-crypto bets.
And ETFs, as such, seeing monumental flows. We'll break down where the record-setting capital is going. All of that and more coming up. But let's take a look at where markets are trading after quite a week last week. The S&P 500 up 4.7% last week. That momentum continuing a little bit today. You can see the S&P 500 up about 0.3%. Big tech, it's a similar story. You can see currently higher by about 0.3% on the Nasdaq 100. The bond market is closed today, of course, for Veterans Day. And maybe it's good that bond traders are getting a bit of a breather because, boy, has it been wild. And you can see that the 10-year Treasury yield closed on Friday at 4.3%, Matt Miller.
Yeah, just about the level from the week before. That is not the case with Bitcoin. We continue to see a rally. These are ETFs, and the surge in flows, something we're really going to drill down on today, has been exceptional. In fact, the biggest flows into Bitcoin ETFs since their inception after Trump's big win last week.
A lot happening from Bitcoin into the equity world. There's a lot happening elsewhere as well. I'm watching Cigna, which confirmed this morning that it won't pursue a merger with Humana. Political uncertainty is also putting the spotlight on future of Medicaid and Medicare. So I'm watching Cigna very closely. Of course, doing very well otherwise, up more than 6.6% pre-market. But Humana, on the heels of no deal, now down more than 5.6%. Also checking in on Tesla extending gains as Elon Musk's influence on the White House and potential benefits to his companies come into focus, Matt. I know we're watching Musk very closely otherwise, too.
Yeah, we're watching him. I mean, it seems like Musk needs to give his go-ahead as well as Trump giving his. We're seeing that certainly in the run for leadership of the Senate. Musk backing Rick Scott out of Florida. Scott then asking Trump to please weigh in as well. He lost bigly last time, but he could win in this round. And speaking of Elon Musk and the gains in Tesla, take a look at Rich Go on your Bloomberg terminal. All of, I think, the top 15 richest people in the world have gotten richer this year if they were American or in America, right? Bernard Arnault sinking down a little bit. But Elon Musk has added about $20 billion to his net worth over the last week, surpassing, again, $300 billion in personal wealth.
It's amazing. I mean, a lot of that comes to the rally that we've seen in Tesla, in the broader stock market. And Elon Musk is a special case in many ways. But you think about the week we had last week. If you touch U.S. equities at all in your personal account, in your retirement account, the S&P 500 was up 4.7%. That is the best weekly performance of this year. So the wealth effect definitely coming in last week.
Yeah, absolutely. And if you think about what is ahead still, we are waiting on the final conclusion of these Republican House races as well. The House races more largely, the party is gaining more steam in the House. And if you have that full red sweep, it means very good news in terms of taxes for not only billionaires, but also corporations. Interesting to see the bond market.
Well, and maybe also for regular people, right?
Yeah, speaking of the 401k effect.
Absolutely. All right, we're going to continue to drill down on that for sure, and everything that's going on in markets. To lead that coverage, we bring in Advisors Capital Partner and Portfolio Manager JoAnne Feeney. JoAnne, great to have you on the program with us today. What lessons can we take from 2016? Because a lot of people are pulling out those old playbooks and put them to use today. What have you done since the election?
Yeah, good morning, Matt. Well, we walked into the elections with that view most people had that it was sort of pretty close race and 50-50. We have already built portfolios that have some resilience to policy changes. I think at this point, people have to recognize that a lot of money flowed back into equities last week, and that caused sort of everything, or most everything, to go up. From here on, though, it's going to be a stock picker's game, because clearly some of the policies that have been floated are going to have winners, but they're also going to have losers. And now is the time to start digging into the details.
When you dig into the details, JoAnne, there are some sectors that you had voiced to us before that you were interested in that I'm wondering how you view now and the potential gains. If you see more or less under a red sweep, defense in particular, I'm interested in whether you would double down at this point.
Yeah, Sonali, defense clearly is an industry that's going to benefit from the incoming administration, and we already saw some of that last week. But particularly, the U.S. needs to restock its munitions. We need to recognize that the type of munitions, the type of equipment for warfare is changing dramatically, has been sort of proved out in the Ukraine-Russia war. We own in growth strategy, for example, a smaller company called Kratos, which specializes in drone technology and engines for drones. We think that's going to continue to be a really good opportunity. But the bigger guys as well, Lockheed Martin, Raytheon, we like those. And yeah, that's certainly an area, but there are others out there. And so, when you look at the potential tariff policies that might come into play, that's going to make some within sectors winners, but others losers. So it isn't purely a sector play that we have to think about here.
And JoAnne, overlay, of course, this relief rally, if you want to call it that, of course, this post-election clarity that we're seeing in the stock market. With what we learned from earnings season, there was a great note out from DataTrek this morning that showed that 75% of S&P 500 reporting companies beat this season, but that's pretty below where we've been on a 1-year average, a 5-year average. It's bang in line with the 10-year average. That seems pretty underwhelming.
Yeah, I mean, it's typically the case that the analysts on the sell side underestimate what companies will do. So the 75% beat isn't a surprise. And in fact, they beat by a smaller margin than is historically typical. So it wasn't like we had blowout earnings. But what I think is more important is that the year is expected to end with the S&P 500 having earned 12% more than they did last year. And even more importantly than that, 2025, at least with current estimates in place, looks to see earnings grow another 14%. Now, those numbers are going to be really sensitive to policy. We see the potential benefit of lower taxes, particularly lower corporate taxes, and that's sort of a repeat of 2017. That certainly would help more across the board. But those tariffs and the immigration policy are going to have really disproportionate and diverse effects across different kinds of companies. You look at immigration restrictions driving up the cost, particularly of lower skilled labor, construction, retail, hotels, et cetera. So that could really crimp their margins. That's something to watch out for. And then on the other hand, the tariffs could help some domestic companies because they'll get protection in the form of higher imported good prices, helping them. But then you look at M&A and deregulation, and there are also winners and losers there. So this is really the time for investors to roll up their sleeves. And fortunately, we're individual stock investors for our clients. We think this is a particularly bad time to be an index or a broad market investor because there are going to be definite winners and losers.
I mean, there will be winners and losers when this legislation comes out, but that's a long way off, right, JoAnne? At some point, don't you have to play the animal spirits game? I mean, everything's rallying right now, not because anyone knows what tariffs or taxes are going to change, just because, we're buying stocks. Do you ever find a way to track animal spirits well?
Well, yeah, Matt, I mean, I think animal spirits can work in the short run. But, if you're a long-term investor, you want to be positioned for not just this month, this quarter, but for multiple years. And that's where the hard work comes into play. We put out a note this morning, talking about the puts and takes, the beneficiaries and the losers in this kind of a situation. And don't expect those policy changes to be too far off. I mean, Trump has made it clear that on day one, he's going to make some changes, and that could be to immigration, that could be to tariffs. Remember that the president doesn't need congressional authorization for a wide range of tariff impositions. So that could change more quickly than people realize. And while folks are playing the benefits on the macro front from deregulation or opening up the M&A, On the other hand, the macro situation could deteriorate with higher interest rates, with those potentially inflationary policies that are coming down the pipeline as well.
All right, JoAnne, that's a good place to leave it. Really appreciate you kicking off the week with us. That is JoAnne Feeney from Advisors Capital. Meanwhile, let's take a look under the hood now and see some of the stocks moving ahead of the opening bell. We'll do that with Abigail Doolittle.
Starting off with a big laggard, we do have the shares of Monday.com, Katie, down sharply, plunging even, down about 15%. They actually beat adjusted earnings by 35% to put up 85 cents per share. But in terms of the current quarter view, the inline revenue not being cheered, plus their chief revenue officer stepping down. The stock on the year up 73%. So price to perfection when you compare that to Microsoft at up 12% on the year. There's a lot of a cloud component here. Investors wanted that perfection. They simply didn't get it. Turning to some pieces of the Trump trade, we do have the crypto space absolutely on fire, as all of you have been talking about. The anticipation that the Trump administration is going to be friendly to crypto has Bitcoin at $82,000 per share, really defying some of the bearish technicals, the consolidation technicals that had been at play. And you can see some of these crypto-related names going along for the ride. And then finally, speaking of the Trump trade, a new piece of it, Tesla heading to a fifth day up in a row, up about 7% right now, defying some of the shorts. Although at this point, Sonali, there's not a very big short interest on Tesla, about 3%. And we do have Dan Ives over at the big tech bull. Well, he's raised his price target to a street high of $400 per share, and that stock maybe headed in that direction.
Certainly the short squeeze, although not the biggest component here, part of the story. Abby, we thank you so very much for keeping an eye on all things under the market for us. Coming up next, speaking of the market, investors pouring over $30 billion into ETFs last week. We're going to take a look at the top flows next. This is Bloomberg.
Let's get out of high interest to look at what's making headlines around the world. Schroders is reducing the size of its executive committee from 22 members to 9. The company's new CEO is looking to revive growth for the UK's largest standalone asset manager after the stock slumped 50%, more than 50% this year. The CEO did not rule out wider job cuts. And German Chancellor Olaf Scholz says he's open to moving up a parliamentary confidence vote to before Christmas. That would potentially speed up the country's early election in February. Scholz's government collapsed last week after he fired the country's finance minister. And hedge funds are betting against Tesla. They've lost over $5 billion since Donald Trump's election win. That's according to data compiled by Bloomberg and S3 Partners. Since Election Day, Tesla shares have gained close to 30%, totaling well over $200 billion in added market value, pushing the company to more than $1 trillion. Katie?
And that is great news for Elon Musk and really everyone that's invested in those broad benchmarks, given that Tesla has a big weighting there. But let's shift gears here. Let's talk about the flow show, specifically in the ETF universe. At least in the U.S., ETFs took in nearly $59 billion last week. We saw Bitcoin, we saw financials, and really feels like everything taking in money. Let's talk about it with Emily Griffeo. And I want to start with Bitcoin because Bitcoin reaching a new record high. It's well above $80,000 per coin right now. And you're seeing that reflected in the product suite.
Yeah, this was a product, at least IBIT, which is BlackRock's Bitcoin ETF, the biggest Bitcoin ETF. People had been piling in even before the election results came in. So for 4 straight weeks now, IBIT has taken in over $1 billion every single week. And then after Trump won the election, we saw record inflow into IBIT. So on Thursday of last week, we saw the biggest inflow that IBIT has ever taken in. So even after the funds were first approved in January, and we were talking about these huge flows, the scales of the flows is even bigger right now for Bitcoin.
Bitcoin total market cap right now over $1.6 trillion, according to Coin Market Cap. Where else are you seeing the big inflows? And had these things sold off before the election?
Well, so Bitcoin was running up, but a lot of these trades had. So industrials was a trade that people were piling in, and then actually after Trump won, people were selling XLI, which is the industrials ETF, I guess taking profits there. Regional banks, KRE, took in a record inflow on Wednesday, one day after Trump's win. I guess people betting that he'll take a looser regulatory stance on banks. And so it'll be a good idea to pile into both regional banks and just financials more broadly. XLF, which is just a broad-based financials ETF, had its best week all year, $1.3 billion into that fund.
Emily, I'm a little more interested actually in just some of these plain vanilla ETFs, SPY, QQQ. Eric Balchunas over at Bloomberg Intelligence made a point this morning that you saw 12 billion worth of daily flows, 3 to 4 times what you would normally see. JoAnne Feeney making a case that investing at the index level over the long term at this juncture looks a little choppy or risky. Think about where valuations are. I mean, what was the scale of moves you saw across the universe outside of just these areas where you would expect to do well under a Trump administration?
I think your guest makes a good point that you're typically always going to see people buying an S&P 500 ETF. People in their 401ks are not, trading in and out based on who wins the presidency. But we really did see a scale that was bigger than normal. The day after the election, we saw inflows that were 16 times the average daily inflow, volume that you see. So people really, I think, were taking the rally and trying to ride it out and buying more than usual stocks. And then also long bonds. TLT is getting some pretty big inflows. I'm not sure if that really makes sense with rates where they are, but people love TLT as well.
Bond investors just love pain. They seem to crave it when it comes to the likes of TLT. What's interesting, though, is that it's not just flows necessarily where you're seeing this bullish positioning. If you take a look in the options market as well, you've reported on this, that you take a look at IWM, for example, which tracks the Russell 2000. The options positioning is pretty strong.
Yeah, there's more volume in bullish options versus bearish ones. Small caps, I guess that's another bet that if Trump is taking a more pro-domestic manufacturing stance, smaller companies typically have more of their operations in the U.S., so that'll be a good win for small caps. But it also feels like all year people have been trying to come up with an excuse for why they want to invest in small caps.
And you can make up any argument. You could say, like, tariffs are bad for big caps, but good for small caps.
Well, they're not, as internationally focused.
But mass deportations. I mean, if you really deport 15 million workers from this economy, you got to expect labor prices to shoot sky high, and small caps are typically dependent on those, not to mention the fact that interest costs are still relatively high.
That's true.
And the Fed looks like it's going to cut less, right?
Yeah, bad for small caps. So there's a lot of cross currents, I think is fair.
Yeah, one of the points that I made in an article that I wrote last week was that a lot of those Trump trades, specifically small caps, don't really make sense.
I got to cut you off, Emily. Thanks so much for joining us, but we are going to honor 2 minutes of silence for Armistice Day and Veterans Day. Let's look at the New York Stock Exchange and the NASDAQ.
All right, welcome back to Bloomberg Open Interest. You're taking a look at futures now with about 5 minutes to go until the bells ring. You can see we have another rally on our hands, and that's after the rally that we saw last week. Remember, the S&P 500 up about 4.7% last week, the best weekly performance of 2024, and looks like it will continue today. The S&P 500 up about 0.3%. You have big tech participating as well, up 0.3%. And then you have the small caps in charge, at least for the time being. The Russell 2000 up about 0.9%. And we were just having a conversation with Emily Grafeo about how people are really putting money on the small caps right now in a big way in the ETF industry. And then you think about all the cross currents, guys, the facts that higher rates might be here to stay. That could spell some trouble for those smaller companies.
Yeah.
Well, you made a really great point about those cross currents. People just talk about the debt load. You were talking about labor costs, worries about inflation next year. I think we were talking about this a little earlier, too. David Zervos over at Jefferies making the point here. Yes, complicated argument about the idea of a flattener, but really what he's saying is that the long term won't be as high.
A yield curve flattener.
A yield curve flattener. And the point he's making is that maybe long-term rates won't be so high because, yes, taxes might stay lower, but so might government spending, which means the deficit.
That's a big might.
Big might.
That's
There's
a huge
lot of big
might.
But people are trading on a lot of might.
Yeah, no, we were talking about this a lot last week. I think everyone, especially his opponents, took seriously Trump's threat of tariffs, tax cuts, and deportation. But no one took seriously the idea that Elon Musk could cut $2 trillion.
Funny how that goes.
Yeah.
This is Bloomberg.
All right, we are after a 50th record high on Friday. At one point, the S&P 500 was well over 6,000. We're moments away from the starting bell today. You can see that we're looking at gains again in futures. So it looks like the Trump trade continues, and we could hit and breach that level straight away at the open today. You hear the opening bells at the New York Stock Exchange. And actually, I noticed the New York Stock Exchange opening bell is down on the Intrepid to honor Veterans Day and Armistice Day. Also at the NASDAQ market site, you have leaders representing veteran-owned businesses ringing the bell. So a real focus there on honoring the veterans, but still not a holiday. I don't know why we're still trading equities today. If we really honor the veterans, I feel like we should take a day off. If we did, though, we wouldn't get another record high. And Katie Greifeld, it looks like we did pierce 2,000 and open above it. Sorry, 6,000.
6,000. Yes,
Yeah.
we are at 6,000. And I will point out that the bond market is closed, so one of those strange days. But in any case, you're right. This rally is building right now. The S&P 500 up about 0.3%. That's enough to vault it over 6,000. Once again, you take a look at big tech, also higher by about 2-3%, 2 to 0.3%, that is. Then you take a look at the small caps, and once again, that is where all the action is. You think about these Trump trades that are being expressed, and they've shown up in a big way in the Russell 2000, higher by about another 1% so far today. Meanwhile, let's take a look at some individual movers, and we start with Cigna and Humana. Shares moving. That's after Cigna confirmed it will not pursue an acquisition of Humana. Cigna also reaffirming its 2024 outlook. All of that spelling good news for, of course, Cigna. You can see shares up by about close to 8%. Meanwhile, on the other side, Humana down about 5%, Sonali.
And Katie, I'm taking a look here at Coinbase. It's surging to the most it's been to the highest level since 2021. Remember, cryptocurrency is soaring by and large. There's a prospect of a pro-crypto Congress, and Coinbase is actually up for 7 days, guys. It's up almost 10% this morning, which is a really large jump. But over a 7-day period, it's actually up 65%, just over a week. So a lot of hope here that a potential red wave could help crypto out.
All right, we're also checking in on shares of Tesla as investors bet on Elon Musk's influence in Washington. I was listening to Kriti Gupta this morning on Bloomberg Radio. She said it might be a Trump trade. It's kind of a little bit of a Trump trade. It's a massive Trump trade, and it's now worth more than $1 trillion, pushing Elon Musk's wealth up to more than $300 billion. Let's take a closer look at another big Trump trade as well, which is crypto. For that, we go to Bloomberg's Abigail Doolittle. Abby, what do you see?
Well, we see Bitcoin at a new record high. Crypto absolutely a piece of the Trump trade, given the idea, the sense that the Trump administration is going to be pro-crypto, and that if there is a trifecta, a red wave that Sonali was talking about in D.C., that there could be members of Congress that will also be pro-crypto. All of this, again, has Bitcoin at an all-time high. And it started last week, so we can really see the Trump piece of this. The inflows for some of the Bitcoin ETFs, well, the day after the election really went bonkers. A record inflow for this crypto ETF, and you can see lots of green here overall, perhaps in anticipation, the Trump trade really taking off a couple of weeks, months ago. But again, last week, that massive inflow. Finally, let's put it all together with some of the crypto ETFs on the day. So there's that Bitcoin ETF up 7%, 2 times Bitcoin, not surprisingly up double, and then MicroStrategy and Mara Holdings also up in big, significant ways. Investors love this crypto. And Katie, it's super interesting because the technicals on Bitcoin had been interesting, but a lot of these quote unquote impossible trades coming to life with the anticipation of the Trump administration.
Absolutely. Abigail Doolittle, thank you so much. And let's keep that conversation going now with Citi Global Wealth Chief Investment Strategist and Chief Economist Steve Wieting joining us at the desk now. Steve, it's great to see you in person.
Good to see you. Thanks for having me here.
So the election is in the rearview mirror. Talk to us through how you were positioned heading into the vote and how it's changed since then.
Well, U.S. equities have risen to 65% of the world, but our weightings across U.S. themes were 6% overweight that, including profitable small and mid-cap U.S. stocks, which I think, if you're a little bit worried about how far large caps have run, we're talking about equities that are still about 5% below their long-term historical average valuation, about a third less than large cap growth. So there's been a very big disparity here. I think that there's some catching up if there's some broadening in performance. It's really a story of haves and have-nots across the world. I mean, global equities are trading at 13 times, ex-US, 13 times forward EPS. And the question is, we're a little cautious about the effects of a rising dollar if we had a red sweep, and that's exactly what's happened. So it's a cheaper entry point, but we're not quite sure exactly how we'll exploit that.
Talk to us about the risks to small and mid cap in particular,
Yes.
because there are plenty, including potentially higher interest costs. Matt made a good point about uncertainties about future labor costs. If you see mass deportations, just the job force changing, the workforce changing in the United States, what does all that mean?
Yeah, I just would, again, distinguish a little bit from a cyclical trade, right? I think deregulation, this whole thing is pretty powerful for cyclicals. It certainly includes financials. Whether it becomes a growth paradise for troubled companies is a different story. And so we're exploiting this through already profitable companies that have relatively lower debt burdens that are sitting essentially in growth indices. So if you take a look at the S&P 400 and 600 growth indices, these are the specifics. So these are a little bit up in quality, and they're a little lower in beta. So they will not necessarily be swept up quite as much as, again, the lowest quality type companies. But we think that these have really been systematically underpriced as opposed to Russell 2000.
Stephen, you've been in this market for quite a while now, and I'm sure, like me, you've heard so many people say there's so much cash on the sidelines, and I've heard it again today that institutional investors have still 20% in cash, so they'll be able to fuel a continued rally. How much faith do you put into that idea?
I'm a little troubled by that because, hey, maybe we could put some of the stock market money and add to that, but I think it's really the change, right? The buildup in cash, the delta, which has still been very strong. Now, again, that's been coming down some, but if you look right behind us, we have had a very large buildup in cash from the sidelines. There are a lot of very wealthy clients that have been rolling T-bills, and they're like, I won't believe this until rates come down. Now rates have come down. And there could be some performance chasing, again, out of that money. So I do think there's something there.
How far do rates come down? There's a lot of debate here about where the 10-year goes. It's been holding pretty steady at 4.3%. It got as high as 4.5%. Is the direction of travel higher?
Well, we think it can be. and we've adjusted our views, again, on the red sweep. First off, every Fed easing cycle has been a yield curve steepening cycle, right? And again, if we back off a little bit, we can move back and forth on this thing. But Fed tightening periods have been yield curve flatteners, and easing cycles will be steepeners. The Federal Reserve is not going to make assumptions about what fiscal policy is going to do. And by the way, we think that U.S. fiscal policy will change more dramatically, if at all, in 2026, not 2025. Again, this has to be legislated through Congress, and there's a big process around it. But if we have, again, some promises of easing fiscal policy in 2026, I think that the Federal Reserve doesn't cut quite as far as it otherwise would. Maybe it's another move, and maybe it's just 100 basis points from here. If the economy is firm as we think, because we had a lot of problems back in 2023 that we're actually recovering from, you'll see a curve steepener. And that's something I think that can help financials. I don't think it's devastating for the bond market, given how low yields are around the rest of the world. But, you know, we have a little more caution on rates.
And I think a lot of people would like to see a healthier curve. It is not exactly what Jeffrey said out in a note, expecting a little bit of a flattener there. But before we let you go, I want to talk a little bit, again, about how you allocate in this post-election environment. There was a really interesting investment letter from BlackRock's model team that went out last week, and they're basically positioning for broad risk on. They don't want to be looking at specific sectors, making specific calls on electoral outcomes. I'm wondering how you're thinking of threading the needle between these broad risk on allocations versus getting a little bit more specific.
Well, I would just say that we'll find, when we look back, it's going to be pretty specific. But we've, traded election-related uncertainty. Who will win? What will be the makeup of Congress, with policy uncertainty over exactly what can get implemented, what are the priorities, what's the process. Again, we'll watch again the new administration and who the choices are and how they pursue these things. I think that you'll find that the outcomes will be pretty specific. But it's certainly better to be specific than to just say, hey, I love the Western Hemisphere, or or the East, that sort of thing. But I think for now we have to live with the uncertainty, and we'll have a lot of knowledge about what comes in, but really prepare where there's some undiscounted value still. And I think that that's still fairly broad in the equity market. It's certainly broader than just the Magnificent Seven.
Stephen, we thank you so much for joining us
Thank you.
here on Set this Monday. That is Citi's Steve Wieting. Now, there's one stock we are watching right now, and it's AbbVie. Shares are sinking after 2 trials of its drug to treat schizophrenia had failed to meet its goals. You now have AbbVie down more than 11.5%. That is the worst you've really seen since March of 2020. It's a tale of two cities here, isn't it, Katie? I know you're watching some others who have been having more success with a similar drug.
Yeah, and of course, this is bad news for AbbVie. Up until this point, they had been outperforming the S&P 500 on a year-to-date basis, but clearly that drug trial really taking it down. But to your point, Bristol Myers Squibb, this is good news for that company. You think back to September, they gained U.S. approval for the first new type of schizophrenia drug in 7 decades. So there's your pair trade right now. Bristol Myers Squibb up about 11% to AbbVie's 12% decline.
It's pretty much money in the door, money out the door. Now, coming up, we mentioned Bitcoin and crypto stocks surging on the hopes that Trump will put the U.S. at the center of the digital asset universe. We're going to talk more about that trade next. This is Bloomberg.
Welcome back to Bloomberg Open Interest. Let's take a check on that rally underway in the stock market. You can see the S&P 500 still up to the tune of about 0.3%. This is on pretty hefty volume as well. I can't say the same for the NASDAQ 100. That early bid into tech is fading right now. The NASDAQ 100 flipping into negative territory, but the small caps hanging on and then some. The Russell 2000 currently higher by about 1.1%, Sonali.
And a crypto buying spree is underway as traders bet that Trump will usher in a new era of digital asset investing. That means Bitcoin is now at an all-time high or near it, while stocks like Marathon Digital and Coinbase surge as well. We're going to bring in Metafide CEO Frank Speiser, and fascinating to see Bitcoin hit 82,000 or more, but how much more upside is there? You know, how much is this the, buy the rumor, sell the news kind of story at the end of the day, especially when you realize—
Buy the rumor, buy the news is what it was. We were up, and then Trump got elected, and then we're up.
But nothing's happened yet. Like everything else you've seen.
Okay, that's a good point. That's a good.
Absolutely.
The news hasn't come yet.
There's
is your
no
point.
new SEC chief yet. There is no new head of all these regulatory agencies outside of that. Frank, what do you think?
Well, first of all, thanks for having me back. I would say the markets still have a ways to go, because what you're seeing right now is primarily institutionally driven buying. It's people that have been, soaking up the BTC that was available through the exchange liquidations, and now those are pretty much burnt off. But retail hasn't come back in. If you look at the size of the buy orders that are coming in, they're all fairly large. You're not seeing drips and drabs like you would. And you're not seeing your Uber driver checking their portfolio as you're driving around now. When that returns, I think that the market can go considerably higher.
I mean, I would buy that there's more institutional interest in this run-up than there has been in the past. On the other hand, Doge has run further faster, right? I think it's up 80-some% year to date. How come people are buying this? And please tell me, institutions are not buying Dogecoin.
I don't know if institutions are buying Dogecoin. They're not large buys. It seems speculative, but if I had to put my bet on it, I would say they're expecting Elon Musk to do something with Twitter and bake it into that platform for its censorship-resistant qualities. If you have a token that you can use to monetize a platform in jurisdictions where the governments are sort of prohibiting, their currencies to be traded, Doge is a way around that and a way to monetize the platform. It may not be the only token that Musk uses, but I actually anticipate him to work that in order to continue to, move the platform away from free speech restrictions in jurisdictions that are a little more restricted.
Just to tie a bow on the Dogecoin discussion, if you're a big institution watching right now and you're buying Dogecoin, come on with us. We just have a couple questions. But Frank, let's talk a little bit more about the mix between retail and institution when it comes to Bitcoin. And let's bring this conversation to the Bitcoin ETFs, which are seeing so much interest. And at first blush, you might think that's all retail buying these ETFs on their brokerage platforms. But we have seen a lot of hedge funds come in through the wrapper. Yeah,
it's I think a lot of people feel, a lot of hedge fund managers feel that there's a little bit more to go, a lot more left in this market run up, and they don't want to be left out. Everybody has to have a piece, and it's a really easy way to be involved there, especially when you're looking at the compliance and regulatory requirements. It's a great way to get involved with the asset, and I think it's going to work for them. It's going to work for retail investors, and it's an overall good way to be involved in the market.
Frank, if we think about what's next, you said Bitcoin could go materially higher. What's the price target? I mean, where do you think it ends next year?
Well, I was on this show and I said it would be 100K by the end of the year when it was about 58. I think, given where we're at, I wouldn't put 150K out by the end of next year. And I still think that 100K was within reach this year as well.
We saw Mara Holdings take off. We saw Coinbase take off. I mean, any number of crypto-related stocks. And on that note, I wonder about Metafide. I know you want to get into broader trading, maybe equities trading using AI. Just give us the quick elevator pitch about your business expanding.
Yes. Metafide uses AI predictive signals to forecast asset prices, and we use humans to compete with them to fine-tune them. And we've been primarily involved in crypto asset predictions, but we're over the next 6 months moving into broader equities and commodities forecasting, and those products should be out, very soon after the new year.
Frank, really enjoyed this conversation. Of course, Frank Speiser, he is Metafide CEO, and it's just wild. I was taking a look at the one-year chart of Bitcoin. We were below $40,000 last year, and you still had people coming out with those $100,000 calls, and you called them crazy, but here we are, $82,000. I mean, 100K looks reasonable almost.
You think about the impact that Fairshake, which is the PAC that was funded by A16Z and Coinbase, how much influence they had in the down ballot races. and you consider what that means for regulation moving forward, maybe finally a stablecoin bill, maybe finally some of the SEC enforcement actions being put away under a potentially new chief, the SEC chair tends to step down pretty quickly into a new administration.
Well, and Trump said if he doesn't, he'll fire him. So I think you can pretty much count on Gensler being gone and all of that regulation being absolutely trashed. And bringing in new regulation, maybe that the crypto industry, to your point, will embrace, maybe has written themselves. Coming up, President-elect Trump narrowing down his Treasury Secretary shortlist. It's Scott Bessent and everyone else. We'll take a look at those picks in today's Wall Street Beat. This is Bloomberg.
And it's time now for the Wall Street Beat. Today we're looking at who may be the next Treasury Secretary as President-elect Trump weighs his options. Joining us with more is Bloomberg senior Washington correspondent Saleha Mohsin. And want to talk about Treasury. You are so steeped in this subject. But first I want to talk about the one person that looks like he's going to trade, Robert Lighthizer, because he was on that Treasury list earlier on, now opens the door a little bit for new candidates. You are an expert in the dollar. What does Lighthizer a trade mean for Wall Street?
Well, one thing, actually, I want to correct the record there. Bloomberg did publish a story today that says that over the last couple of days, we've learned that between Election Day and the conclusion of our reporting over the past few days, Bob Lighthizer was not offered the USTR role. He was not offered the job to return to that role as he was during the first Trump administration. So Lighthizer could still be in the mix for Treasury.
I look at the betting markets, Saleha, and I pay extra close attention to them now. Scott Bessent, you want to buy that at 73 cents. And the next biggest is Howard Lutnick at 10 cents. So is this a pretty lopsided race? Do we kind of know that Scott Bessent is very likely to get the nod?
Well, that's the thing here. It's not a race, right? No one gets to vote on it. There is no polling on it.
One person votes.
It's just what people are reporting. One person votes, and that man has not weighed in. So we don't know whether Bessent is up and Lutnick is down, or Bessent is down and Paulson is up. We just don't know. It's going to come down to what the president-elect decides. We know that the list of potential Treasury secretaries will be narrowed down by the end of this week, and then we expect to have interviews and then hopefully an announcement.
A good reminder, of course, this comes down to Donald Trump, but boy, is it fun to speculate. And we know that he's getting advice. Of course, Bloomberg has reported that those close to him have suggested that, for example, Saleha, for Treasury, perhaps he should pick someone with Wall Street experience.
Absolutely, and that's exactly what President Trump did, or President-elect Trump did when he was president from 2017 to 2021. He had Stephen Mnuchin, who came with a Goldman Sachs pedigree. And so now, if you look at the list of secretaries that he may be considering this week, most of them have a Wall Street pedigree, and that is, history tells us that that's what he's going to go for.
All right, Saleha, thanks so much for joining us. Bloomberg's Saleha Mohsin continuing to... I thought you were going to get some time to sleep, Saleha, frankly, after the election. But obviously, she's continuing to do the 24/7 reporting schedule. You look like you want to say something.
Yeah, it feels like this list got longer, not shorter, over the last couple of days.
True.
Well, reading some of the reporting, of course, Howard Lutnick has been providing thousands and thousands of names. There's something like 4,000 roles they need to fill. So it is interesting, though, that some of the top slots, Treasury Secretary, the list is getting longer.
But to her most important point, it doesn't really matter what we all think the list looks like. It only matters what President Trump says. And since he hasn't said anything, we're speculating about speculation.
Yeah.
But we'll know by the end of the week. So, it'll move on faster than you expect. Anyways.
Coming up in the next hour, Nimrit Kang joins us from Northstar to talk about deregulation across energy and financials. And we'll talk with Edgewell CEO Rod Little on how he's preparing for potential tariffs on suntan lotion. This is Bloomberg. All right, S&P 6,000 is here. 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, corporate earnings set to become one of the biggest drivers of U.S. stocks as the focus returns to economic growth following Trump's election victory.
Meanwhile, the GOP edges closer to a House win, a victory that would put Trump's agenda on a fast track.
And bracing for tariffs, sunscreen maker Edgewell is locking in suppliers to diminish that threat. We'll talk to the company's CEO later this hour. Before we get there, let's get a check on these markets right now. You can see the S&P 500 holding on to gains, the NASDAQ 100 slipping into the red. You take a look at big declines in NVIDIA, in Broadcom, in Apple, weighing on your big tech index. But the small caps resilient, leading the way. The Russell 2000 up about 1%, of course, as that Trump trade still breathes life into those smaller companies.
And we're going to look at the trade underneath the surface. Hedge funds piled into U.S. stocks and opened the second largest amount of long positions in the past 5 years following the presidential election and the Fed's decision. Natalia Nejevich is here with more.
Hi, Sonali. Yes, so we do see that hedge funds bought a lot of stocks last week, and that buying was mainly driven by buying in macro products such as indexes and ETFs. So these are these macro products. They also covered short positions in large cap as well as small cap ETFs. They also bought, of course, lots of single stocks. And when it comes to specific sectors, we do see that consumer discretionary was the most net bought sector last week. It was followed by financials, of course. It's also considered to be one of the pure so-called Trump trades. Buying in financials was the largest since February 2021. However, on a year-to-date basis, we see that financials is still net sold, and it's way below, positioning is way below 5-year average. Then on the flip side, we do see that hedge funds sold utilities, real estate, and staples. So clearly we see that they are moving out of defensive stocks to more cyclical sectors of the market.
We've seen volatility come way down, whether you look at the VIX or the MOVE index. How are options traders positioned in terms of specific sectors?
Right, so this chart shows positioning for the largest ETFs versus the S&P 500. It's an options positioning, a little bit complicated, but to make it like super simple, we also should look at this chart in a little bit more opposite direction. So let's, for example, look at energy. We saw that traders were really bullish on energy going into the U.S. election. Then the S&P 500 rallied so much that energy sector has become a little bit less bullish versus the broader index after the vote. And the same applies to consumer staples as well as industrials. And then on the flip side, we see sectors like materials and consumer services. This shows that for those specific sectors, traders are now more willing to, less willing to pay for hedges versus the S&P 500. So we could potentially say that a little bit more bullishness is on materials and consumer services sectors.
All right, Natalia, thanks very much. Bloomberg's Natalia Knijevich there talking to us about positioning. Joining us to talk further about is Nimrit Kang, Chief Investment Officer at Northstar Investment Management. Nimrit, I guess people are trying to sort of comb through Trump's campaign promises and translate that into policy. As difficult as that is, don't you just close your eyes and buy in a big momentum rally like this?
Good morning. That's definitely the case. You know, one of the things that we've been very focused on, Matt, is how healthy the economic backdrop is. It has been all through the year. The consumers, there are pockets of weakness, but in aggregate, the GDP estimates keep getting revised up. And on top of that, we have a Fed which is very accommodative. We got the 50 basis point cut in September and now a 25. And on top of this, we have a Republican sweep and an agenda focused on very much pro-growth, deregulation, corporate tax cuts. So it's a go, 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 animal spirits type of a market going on here. But, that's where the market right now is discounting only all the positivity. What we don't know is the impact of the tariffs. You've talked about this, and also what happens with the immigration deportations, mass deportation. And also what we don't know is how the policy acts with the lags, right? So for right now, it seems like animal spirits through the end of the year. But as we take a longer term perspective, we think there's plenty of reasons not to go all in and, throw caution to wind.
Well, later on, of course, where you see corporate America in all of that. You think about the earnings season that we got. It was kind of underwhelming if you take a look at the beat rate relative to the past 1 year, the past 5-year averages. And you think about flies in the ointment. Could slowing earnings growth from here be one of them?
Katie, so the market is always discounting forward, right? And you're right, the earnings season was a mixed bag, and there was a lot of, you had to focus on idiosyncratic drivers for each company. We saw some very good results out of companies where we had low expectations, like an Alphabet. On the other side, what we heard across the board from a lot of industrials was this delay in investment because, a lot of the activity is being held back by what's going to happen to the investment climate, what's going to happen with the election. Now we know that that's in the rear view mirror. We're going to start seeing some momentum build through that, where clients who are holding back can actually now invest back in the US. So that's a positive driver coming forward. Now, the big issue that we don't know is that the impact of tariffs is going to be immediate. We saw this in 2018, where right off the bat, the market sold off 20% when the tariffs were implemented, but then it recovered, got its footing as the corporates started to figure out their strategies to pass through those costs.
Nimrit, Matt made the point. We were up on the day. S&P 6,000, exciting moment, market's higher, but then you look at the NASDAQ 100, the NASDAQ Composite, and even the Philadelphia Semiconductor Index all trading lower at the moment. And so why do you think that divergence is true on a day like today? Do you think that holds? Do you think that valuations become a struggle as we head into the next year?
So it feels a lot to us like a rising tide lifts all boats type of a scenario. The tech, the NASDAQ have been the drivers. The Magnificent Seven have been the drivers of the market all through 2023 and through the first half of 2024. Now, as clients are looking to put new money to work, where is that going? That's going into the sectors and the stocks that haven't participated. But we actually think that's very simplistic way to look at it. You have to take a longer term view. Not all stocks are created equal. You have to look at the idiosyncratic drivers for each stock and what's driving that. And especially not to forget the whole equation with the interest rates. We think there's an upward pressure on interest rates. So you can't ignore that. You have to buy healthy balance sheets and companies that can withstand some of those pressures looking forward.
Of course, what happened today is a lot different than what happens for the rest of the year, right? It looks like, to Sonali's point, that you could see the big tech stocks drag the S&P down today from the slight gains that we're looking at. But for the rest of the year, I wonder how much higher we can go, Nimrit, into an actual Trump administration as we get more of this information out on who's going to lead different divisions, different cabinet positions. What's your target for S&P 2025?
If we look at historically, right, we think that especially right now, if we have a scenario that's really dominated by deregulation, by corporate tax cuts, the bias is towards an upward momentum on S&P, the equity markets. But that does not mean that we will not have intra-year declines. Even if you look back at the Reagan period in the 1980s, one of the best periods in terms of deregulation stock market returns, every year, on average, we got an 11% drawdown on the S&P. I'm not answering your question because we don't usually do targets by year. We take a little bit of a longer-term perspective, but we are prepared that even in the best of markets, we are going to have drawdowns.
Point taken on the forecast. It feels like all of them are wrong anyway. So in any case, Nimrit, I am curious how you position around that, the fact that you are expecting this intra-year volatility. How do you construct a portfolio in anticipation?
Katie, we do a lot of upfront work. We know what we want to own. And the kind of companies that we want to own, we're bottom-up stock pickers, the kind of companies we want to own, which have more of their fortunes under their own control. So one of the examples I love to give is that it doesn't matter if we have a Republican sweep or not, people are getting older. You know, people age over 65, that population cohort globally is expected to double over the next 3 decades. So we're very focused on identifying companies that are going to provide solutions for this type of cohort.
What do you
One
call
example
them,
is
Nimrit? What are the names? Give us some names.
Yeah, the one that I want to talk about today is Stryker. Stryker is known for their knee and hip implants, but it makes something like 60,000 products, and they're like medical beds, they're like orthopedic spine, orthopedic screws, and power tools that are used across the board. And as you look forward, you know, people might be getting older, but we still want to live healthy, productive lifestyles. So that's a type of a company that is expected to have secular tailwinds. It's run by very good management, good execution track record, healthy balance sheet, strong capital deployment. So those are the type of names we would be focused on. If we get opportunities during a drawdown, we would add to our positions there.
I want to talk, Nimrit, about another sector here that has had a very strong bid on the heels of the election. I know you're trying to look at what goes well either way, but fascinating moves here in the financials. You're watching the KBW Bank Index, another day of every single stock in the green. Goldman Sachs, Morgan Stanley, both hitting new record highs today. Wells Fargo just soaring as well. And so if you think about what's happening in the bond market, the yield curve has actually been less steep today. And again, it's just one day, but and Friday as well, than it was in the middle of the week or even the weeks prior. How contingent is this bank's trade on that steepener, do you think?
Yeah, you know, the financials, not all financials are created equal. And I'll start off by saying that we've lived through different cycles of this on financials, both under the Trump administration and then the Biden administration. You look at it, financials in general as a sector underperformed the market. But still, you know, within that, there are definitely stocks that tend to do well. So, you know, the yield curve has been fluctuating all year long, right? In September, we were at 3.8 for the 10-year, and now we're looking at above 4.3%. So a lot of fluctuation going on, a lot of back and forth. We think that the pressure is upward on the yield curve. The Fed here is cutting, but they might have to reverse this depending on what they end up seeing with the tariffs, the inflation impact from mass deportation and tariffs and so forth. So it's too early to bet the farm one way or the other, we think. We think we have to play this out, see how this all shakes out. And meanwhile, focus on those financials where we think they're going to be okay, irrespective of what happens to the yield curve. But you're absolutely right. Here, they're getting definitely a bid in this kind of an environment.
All right, Nimrit, thanks so much for joining us. Nimrit Kang there of Northstar Investment Management. Coming up, we're going to go back into politics as the GOP edges closer to a House win. We're going to talk about who could lead the Senate. We're going to talk about the new border czar and what else could happen with a pretty decisive red sweep. This is Bloomberg. Let's get now to high interest to look at what's making headlines around the world. The Kremlin is denying a report that Russian President Vladimir Putin had a phone call with President-elect Donald Trump, calling it, quote, pure fiction. The spokesman said there are no specific plans yet for any contact between the two leaders. Now, President Trump is weighing in on the race for Senate leadership. In a post on Truth Social over the weekend, Trump said that anyone running to be the next Senate Majority Leader should agree to let him make recess appointments to his cabinet. Elon Musk has publicly endorsed Florida Senator Rick Scott after he backed Trump's demand for recess appointments. And Republicans are edging closer to retaining the majority in the House. The latest tallies show them ahead with 213 seats compared to 203 for the Democrats. A majority would give Republicans control of both chambers of Congress as well as the executive branch, and I believe there are still 19 races to be called. California is particularly slow in terms of counting votes. Let's stay on politics. Joining us now from Washington, D.C. Is Bloomberg Politics editor Laura Davison. Laura, correct me if I'm wrong, 19 races to go. How likely are the Republicans to take a majority in the House?
Right now, they are very strongly positioned, just because of the broader wave of Republicans, sort of everything breaking their way this race, plus just that they're, about 10 seats ahead of where the Democrats are right now. This looks like they will have a House majority, and you already see Republicans starting to plan out for what that means policy-wise, particularly when it comes to tax cuts, when it comes to immigration. It is much, much easier to pass the types of policies they're looking for if they have both a majority in the House, Senate, and, of course, Trump in the White House.
And Laura, talk to us about the request for recess appointments, of course, making these appointments while the Senate is out of session. How unusual is that? How likely is that to happen? Give us some context.
Yeah, this is very unusual. Senators usually do this thing where they have what they call pro forma sessions. They basically sort of gavel in on the days that they're, essentially on recess. And that just means that they're basically in control of the Senate floor and that the president of the White House can't appoint different appointees while they're out of town. This has been the case for a long, long time. And you really see Trump is really trying to tighten his grip on Senate Republicans. That, in his first term was sort of his greatest check on power in Washington when Republicans had a full sweep. And so you see there, he is basically kind of imposing some of these loyalty tests as Republicans look to pick their next majority leader. Mitch McConnell is stepping down. He will still be in the Senate, but you have three different candidates who are vying to be that top Senate Republican majority leader. And this is sort of really how you see them positioning themselves to say, look, I am Trump's number one guy here.
Certainly a massive, massive focus this week, Laura. But what about the House as well? Because we're getting closer to figuring out the outcomes of just how red the Senate will turn, whether there will be a full red wave. What do we know so far, and what are some of the more critical spots you've been watching that could change the course of legislation moving forward?
Yeah, so if Republicans are able to hang on to the lead that they have now in the House, it means they can do this thing called budget reconciliation. And this is a bunch of Washington gobbledygook. But essentially what this means is that they only need a simple majority on, key tax and spending legislation. So Trump's tax cut bill, which will be negotiated next year, much of it is up to expire. That means they can get it through the House on a simple majority and avoid the Senate filibuster rule. So they don't need to get 60 votes in the Senate. They just need to get 50. That totally changes the size and scope of what this bill can be. Instead of, basically being sort of a relatively narrow discussion about the expiring provisions and Democrats getting a little bit of what they want, Republicans having to make some concessions, it can now be a total Republican-only bill. We could see some of the things that Trump has talked about on the campaign trail, like no tax on tips, a further cut to the corporate rate. All of that is on the table if Republicans hang on to the House.
Personally, I only care about salt, right? But I understand that for the market, Laura, the corporate tax rate is far more important. And I think it's pretty interesting that when Donald Trump talked about lowering it to 15%, he often qualified that by saying you need to, manufacture in America in order to get that better rate. That seems very complicated to legislate. Is that going to be something that will take time?
Absolutely. Or the way that Congress does a lot of this is they say, OK, we're going to pass a law. It's pretty vague, and then kick it to the Treasury Department to figure out what those details actually look like. That's pretty typical. But particularly something like that is a little bit more complicated, that could create a lot of loopholes or unintended consequences. Congress should spend a little bit more time on that. That's a lot more difficult than just, changing the corporate tax rate from 21 to 15%. To your point on SALT, though, if Republicans are able to pick up a bunch of seats in Southern California, the state and local tax deduction is a bipartisan issue, at least for those in New York and California. That's also the $10,000 cap is set to expire, so we could definitely see talks about SALT next year. Don't fear.
Well, and Donald Trump promised us that
he
would
a lot of promises out there,
rescind
Matt. Let's see what
the
order
SALT deduction cap
of promises are met. Bloomberg's Laura Davison in Washington, D.C. We thank you so very much for your reporting and your work. Now, we're also taking a look at some moves across asset classes here, because you not only have Bitcoin flying past $83,000 now, you also have the dollar, according to the Bloomberg Dollar Index, at the highest levels in a year. We have seen the steady float higher, and interestingly enough, guys, this is without critical appointments that we know of yet. We were talking about the Lighthizer uncertainty when it comes to the White House, uncertainty around what those trade policies will look like, but the market is betting on America.
Yeah, I don't think the market so much, as you can tell right now, is paying attention to the specific appointments, just, of course, to the direction of travel, and that's what you're seeing in the trade, both in traditional currency markets and digital currency markets.
I think it also says something about expectations for Fed cuts.
Yeah.
Right? Because if you expected more Fed cuts this year, that would be more negative for the dollar. But if rates stay high, exactly. So I think that's pretty interesting. I think only 3 cuts now are priced in for 2025.
You look at the euro and the peso, and you see it in the cross-currency trades as well. But to your point, that is absolutely correct as well. Now, stick with us because still ahead, we're going to talk about Chinese consumers. They aren't buying Gucci bags, but they sure are loading up on pricey yoga pants. We're going to discuss next. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, just another manic Monday, and this one has really got investors down. Monday.com swinging to a loss in the third quarter, with the software maker also announcing its chief revenue officer will step down, shares down about 18%. Next up, Macy's trying to win back shoppers, and one way it's trying to do that is by cutting down on the amount of shoes that it sells. The company's CEO is also reportedly adding more staff in fitting rooms and checkout counters in the women's department as part of its turnaround. And finally, a slowdown in China isn't stopping consumers from buying pricey yoga pants. Lululemon had sales in the country that topped 40%. By 2026, HSBC estimates that the country will account for $13 billion in sales, which will make Lululemon more reliant on China than on Apple or Starbucks. So something to watch there. Lulu shares up about 1.7%. Meanwhile, let's get a check on these markets right now. We're about an hour into the trade. You can see the S&P 500 still green, at least for the moment. Of course, we are just on the knife's edge of 6,000. The NASDAQ 100 down a little bit right now, about 0.1%. And the 10-year Treasury yield, the bond market, currently closed in remembrance of Veterans Day. Now coming up, preparing for potential tariffs. We'll speak to Rod Little. He is Edgewell Personal Care, the CEO, about the steps that he is taking. This is Bloomberg.
President-elect Trump has pledged to put a 60% tariff on goods from China, and CEOs around the world are preparing. Edgewell Personal Care, the company behind Banana Boat and Hawaiian Tropic, is looking to lock in contracts now to help control costs down the line. Many companies depend on Chinese suppliers, especially for important chemicals, a lot of which aren't available anywhere else. Joining us now is Rod Little. He is Edgewell's Personal Care president and CEO. As well as, I know you graduated from the Air Force Academy. Rod spent 5 years serving your country in the Air Force, so thank you very much for your service, especially on this Veterans Day. Let's talk about the chemicals on which you're dependent for some of your products. Why aren't they available elsewhere?
Yeah, good morning, Matt. Thank you, and thanks to all the veterans and those that have served and do serve today to give us the freedoms that we all have and enjoy today. Look, the environment around supply chains actually is actually quite good right now. There's a lot more certainty than certainly we've had the last couple of years. There is some uncertainty around where we might go with tariffs, and when I look at our supply chain, I actually think we're fairly representative of global multinational companies, and that about half our sales are outside the U.S., half are in. We manufacture around the world. And we effectively sell, where we sell product, we make product. So we have a very regionalized supply chain. Most of what we sell in the U.S., for example, we make and source right here. There are a couple of things that chemical-wise, you mentioned specialty blade steel, where those industries just don't exist in the States. And we have to go outside the United States, in this case, to go source those materials. The good news for us is only about 5% of our cost basket would be subject to tariffs, we think, based on where they might go. The bulk of our costs would be unaffected. And there's primarily these specialty types of industries that just don't exist here and maybe are too expensive from an investment standpoint to make work here, that then, we, like everyone else, will potentially be subject to higher cost in some cases.
So with the context that, those materials sourced outside of the U.S. that aren't available in the U.S. are small of your overall basket, just 5%, like you said, even still, for those materials that you can't get in the U.S., what is your plan when it comes to passing those costs on to consumers? What does the decision tree look like versus when it comes to either protecting your margins, passing it on? What are you thinking?
Yeah, our focus has been on cost productivity, Katie. We are very proud of our ability to generate increased cost productivity every single year as a way to offset the inflation that we face. And as an example, the year we just finished, we grew gross margins by a little under 150 basis points. So we have margins up with very little pricing, and that's around the cost productivity work that we do, or we try to eliminate costs that the consumer doesn't care about. A lot of automation, a lot of just looking at how we can optimize our end-to-end supply chain and take out unnecessary cost. We think we can generate 200 to 300 basis points a year of cost productivity, and that will be where we go to first to offset any new headwinds that may come via tariffs.
When we think about those headwinds, the dollar is perhaps one of them. As an international company, Rod, how do you think of it? You have already told your investors, analysts, that it could continue to be a headwind going into next year, but how much?
Yeah, we just announced guidance for the year ahead last week. As you point out, one of the headwinds we do face is a strong dollar. And so those like us that operate around the globe and have long exposures, our longest exposure, for example, is to the Japanese yen. And so as the dollar strengthens versus the yen, everything we bring back is just less valuable as we have to put dollars in the bank. That's what our investors want. And so as we go through all those transactions and trades to bring our foreign currency back into dollars, there's an impact. We're on now what is a 3-year running negative impact or a headwind to our business from a profitability standpoint based on the strength of the dollar. I suspect it will continue to strengthen from here based on what I'm reading. And we're prepared for that. Again, cost productivity is some of the work we go to. We also look at where we do our business and how we create more natural hedges over time. And we do a little bit of locking in and trying to manage the exposures that we have and locking in some rates when we start to look out over the mid to longer term. So there are things you can go to, but in the moment we're in, a strong dollar is something that people like us that operate outside the U.S. with about half our business are going to just face a headwind through this period. I would say offsetting that, however, potentially is lower oil prices. When you look at the petro complex of oils and all the polyethylene, propylenes, and what go into, oil feeding into our business, that's a little bit of a tailwind as well. So there are some natural offsets, but currencies definitely hurt for us with the strength of the dollar.
Well, I mean, if you get a lower tax rate, that would be a tailwind as well. But President Trump has qualified his intentions to lower taxes with, talking about the fact that he only wants to give the benefit to people who manufacture in the U.S. I know you're headquartered here in Connecticut. You've got 7,000 about employees. What does your production chain look like, and have you made any moves?
We would benefit from that. We manufacture most of what we sell in the United States, in the U.S. We make razor blades in Connecticut and Tennessee. Our FemCare brands, Playtex, Carefree, Stay Free, we make in Dover, Delaware. We're the only manufacturer that sells sun care that makes our own production. Everyone else has gone to third party. In this region now, we make our sun care in Ormond Beach, Florida, just outside of Daytona. And Wet Ones, a very popular leading brand in its space, we make in Sydney, Ohio. And so we're a domestic manufacturer. We're proud of that. And we think we benefit from it actually in the environment going forward.
Rod, thank you so very much. That is Rod Little of Edgewell Personal Care, of course, breaking down everything that we're seeing across his business and what it means for him to see a new administration. I am looking, guys, at the price of Bitcoin here, and I'm a little bit stunned because we are looking at Bitcoin surging past $84,000. That means if you bought it at the top of the hour, so 36 minutes ago, you would have made, if you bought one Bitcoin, say if you wanted to spend $81,000, you're almost $3,000 richer from it. I mean, the rise is just stunning. How fast you've seen the daily move just today. And of course, this is a first-time high for Bitcoin. And
still not as stunning as it was yesterday. Right?
Yeah.
It was up more than 6% yesterday.
That's true.
Last week it moved 10% in a day. I mean, Bitcoin is a
this
very volatile
parabolic?
asset. It moves a lot in both directions.
I mean, you think about Bitcoin, it is just entirely momentum driven. So the fact that it's rising so much and has risen so much is probably not so much of a surprise. It's building on itself. It'll be interesting to see when that breaks, if it builds on itself to the downside. But at least for right now, of course, Bitcoin at all-time highs. But let's get a check on these broader, more traditional markets right now. We'll do that with Abigail Doolittle.
Well, the Trump trade rally, it continues. Katie, take a look at the S&P 500. It might not be a huge gain, but we are looking at a fifth up day in a row for stocks, for that S&P 500 up more than 5% over these last 5 sessions. That's the best 5-day streak going back to November of last year. So essentially we are in the best streak of this year, having to do with the certainty around the election, the Trump trade, and the strong possibility that there will be a red sweep in D.C. Maybe the Trump administration will have an easier time pushing through some of the agendas. Now, one of those agendas could be tariffs against China. You can see the stocks down 2.2%. There are some idiosyncratic reasons beneath the surface, but the last time I looked, all members of the stocks down. Many of them do receive a lot of their revenue, of course, from China. Crude oil also lower, down 3%. This could reflect some of abatement of the conflict, at least right now in the Middle East. But again, China, the world's the largest user of natural resources. So tariffs against that region could weigh. But there's that Bitcoin that you all are talking about, above $84,000 per Bitcoin. Really pretty impressive here. In fact, if we take a look at Bitcoin at this record high, it is just outpacing stocks in such a way. And this is actually the all-country index. The all-country index having a nice gain, but the Bitcoin complex up nearly 100% on the year, much of it coming from out of the September lows, which is when the Trump trade really took off. And then finally, beneath the surface, relative to stock movers, we have Coinbase, not surprisingly, rallying in a big way, up 17%. Tesla, another piece of the Trump trade, gaining more than 30% over the last probably at this point closer to 40% since the election. Elon Musk, of course, a big supporter, maybe the biggest supporter of President-elect Trump, and also the thought that perhaps his influence on the administration will in fact help regulation, especially around AI. Qualcomm, one of those chip stocks that receives nearly 50% of its revenue from China, so one of those laggards. And then finally, Monday.com, its worst day since 2022. The outlook, just not so great, Matt.
Monday.com.
With
I don't know who named that.
Mondays.
Abigail Doolittle, thanks very much. There's some companies like MongoDB that you have to wonder, who chose that name?
You know, someone thought it was a great name once
Monday.com?
I mean, Monday is a great name. Monday.com is a great name right now. It is a Monday, and it has a case of the Mondays. The stock is down quite mightily. It's kind of cute,
that's
Matt.
rough.
Let yourself have fun.
By the way,
November 11th.
Are you not?
That story?
Me and Sonali are pretty pumped about Bitcoin $85,000. Do you not?
Over to my side of the
So
desk.
let me tell you, there's just nothing to say. It has no fundamentals. It's entirely risk appetite. We know the story why it's going to go higher and why it's probably going to go higher. There's just not much new there.
I just think it's amazing. Yeah.
7-day gain in Coinbase is almost 80%.
It's a great market if you want to look for superlatives, but not a lot of meat there.
I feel like there's so much support. It went up $34,000 from January to March. I guess that was on the ETF
This is a
approval.
good reminder that the price is worth what someone will pay for it.
Yeah. All right. We're going to talk about this during the commercial break. When we come back from that, we'll get back to market strategies. Cohen Circle co-founder Betsy Cohen discusses the evolution of special purpose acquisition companies, SPACs. This is Bloomberg.
Well, it's time for our Wall Street Week daily conversation and special purpose acquisition vehicles, SPACs, if you will. They first appeared in the 90s. They saw a big comeback in the early 2020s. And David Weston spoke with Cohen Circle co-founder Betsy Cohen about the progression of SPACs and how they compare to other financial instruments.
It was thought of being a shortcut, but in fact, it really, although the time frame may be a couple of months shorter, and the way in which it's marketed may be different, it's really not a shortcut. It's really, if it's properly executed, it should be matched to the company's needs. So there are many companies for whom what they call a regular way IPO is appropriate, but they may be clustered around brand names. So if in fact you have a name that is known to retail investors who now predominate in the market, maybe that's a good choice, but it's really company specific. The SPAC has evolved over the last couple of years as a vehicle to not only provide access to the capital markets for a company, but to reorganize the company's capital structure. And that can't be done in a straight IPO. But the SPAC is actually a merger device. So there's a lot more flexibility. And many of these companies have, particularly over the last couple of years, raised capital in a variety of ways because the market's been tight. And now they need to sort that out. And part of the sorting out, if it is appropriate, is access to the public markets and looking forward, the ability to raise capital in those markets. But it's also an opportunity to take a look at the company's capital structure and say we had to raise money in a certain way in 2022, but maybe that's not the best thing for us going forward. So it's an opportunity to redo that as they go to the public markets.
If I have either own or run a company that needs to get access to capital, perhaps needs to restructure somewhat, why do I go through a SPAC rather than what you call the regular way, through an IPO?
You do that for a couple of reasons. One, as I said, you have an opportunity to use the merger form instead of the issuance form as your device. But secondly, you have the opportunity to provide investors with a forward look of the company. And many of the companies that use the SPAC device are in a high growth mode.
And that was Betsy Cohen speaking to David Weston, who joins us now. And David, great conversation because it was a nice reminder that SPACs, they get lumped into the silly season of the pandemic, but SPACs, they were born in the 90s, and they're a sober, sensible way for a lot of companies to go public.
And I must confess, as maybe my question betrayed, I went into this thinking this is a regulatory arbitrage is what this is. This is just a way of getting around the SEC rules. And she says, no, that's not right. Some people tried to use it that way. We're not disciplined. You had some sponsors who were not the best necessarily, but actually there's a real function for these SPACs. For certain companies, there's particularly very fast growth, don't have a big brand name, and need to restructure what they're doing. She thinks it can be a good device. She's done over 10 of them, actually.
So why are we talking about this? Are SPACs making a comeback?
Well, that's the question. What we did is we didn't call it this, but it's basically one-hit wonders. We said, let's go back and look at some of the things that were really all the rage among us here at Bloomberg for a time, and now you don't hear about quite so much, like SPACs. You know, remember a couple of years ago, it was all SPACs, and now a lot of them didn't do so well. And we also took a look at Smart Beta. Remember Smart Beta? That was way to go. That seems to have been replaced. So we take a hard look at that. And we also go back to some people like Elaine Garzarelli. Does anyone remember who that was? She was the woman who had a fund who said just before Black Monday, go to cash because the stock market's going to crash, and she was totally right. So he said, whatever happened to all these sort of one-hit wonders? Were they one-hit wonders? Was there anything to them?
Well, looking forward to those conversations, of course, on Wall Street Week. David Weston, great to see you to start the week. And you can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg. Well, there was some late breaking news on my Friday evening. That is BlackRock filing for 2 money market ETFs, not mutual fund ETFs. Joining us now is Eric Balchunas. He is senior ETF analyst over at Bloomberg Intelligence. Normally, I don't see you until noon on Mondays, but we have to talk about this because similar to the Texas Capital money market ETF that launched, I believe, in September, this doesn't have a stable $1 NAV.
Yeah, and by the way, the fact that you're excited about money market ETF filings on Friday evening speaks to the dedication that you have for your job.
I was out to dinner. I said, I have to make some calls.
Try explaining that to somebody else. Yeah. Anyway, so this is exciting because money market mutual funds have $6 trillion, and ETFs have cracked a little bit of that. You know, a short-term treasury ETF is similar to a money market fund, but they call them short-term treasury ETFs. Mm-hmm. This is saying, hey, why don't we just throw the label money market fund on a short-term treasury ETF and see what happens. So to me, this is a lot of labeling. But remember,
is it all short-term treasuries?
No,
they have asset-backed securities.
A little bit.
And
like the one on the market from Texas funds is has some Fannie Mae, Freddie Mac in there. But it's close to treasuries. It's also active. They claim they can go and pick out certain parts, but so are money market funds. So it's similar. It's just not the stable NAV. That said, if you look at the Texas one that came out, it's $100 NAV since it launched. I mean, the decimals after the 100 change a little, and so do the dollar decimals if you go out far enough. So, I mean, it's really close. Whether they should label it money market fund if the NAV isn't stable, that's a question that you could ask, though.
What kind of interest do you expect for this? Because it's interesting to see these come out after the first Fed rate cut. We have seen money market assets be pretty sticky, but where do these ETFs draw money from?
Yeah, honestly, this feels a little late. The time to put a money market ETF out would have been like 2 years ago when the Fed jacked up rates, because that's when we saw the huge rush of money go into money market funds.
Here's the correct graphic, by the way. We had the wrong graphic up earlier.
That's true. That's the Texas Capital one. But it is interesting that even though you have had 75 basis points of rate cuts, there's still all of this interest in the short end, both from investors and issuers as well.
So in general, the short end of the curve has been a hot spot for ETFs. So doesn't hurt to launch there. People always want to put a little cash in their portfolio. That said, right now, we're actually writing about how we think the $6 trillion in money market funds is going to start to get FOMO because the stock market just is relentless. And every time it goes up this much, that money does leave. So right now it's a tough sell, but long term, you can't, I mean, a lot of fish are biting in that short-term area, especially if you can eke out a little extra yield for them. That usually sells. Add on the money market label, maybe good things will happen.
You have 30 seconds. Who is this for? Is this for institutions? Aren't they happy in their traditional money market funds?
Yes, I don't think an institution would buy this. I think they need that dollar. Because a big amount of money, you want that NAV to be $1 constantly. I think this is more for the retail and advisor crowd, so that they can, kind of show, okay, we got a money market portfolio for you here. These are also going to be a little cheaper than a typical money market fund minus Vanguard's.
Right.
So that is something they can kind of come to market with, is they'll be twice as cheap as Fidelity and Goldman and some of those other money market funds. So I think the advisor world and retail is who this is for.
All right, Eric, I will see you in an hour for ETF IQ. That is Eric Balchunas of Bloomberg Intelligence. You can see us on ETF IQ at 12 p.m. Eastern along with Scarlett Fu, but let's take a quick check on these markets right now. Of course, fresh off the best weekly performance of 2024. You take a look at where we are right now on the S&P 500. Matt Miller still higher, and
Wow.
big tech making a little bit of a comeback as well.
Yeah, I thought we would turn around and go negative on the S&P after we saw the NASDAQ come down. NVIDIA was off like 2.5%. Apple was down. Those big names. It was Tesla that was holding us up, and I didn't think it could do. We'll see if it holds us up for the rest.
Russell 2000 now up 1.4%. So leading
Even the
bigly,
small caps.
guys.
All right, coming up tomorrow on Open Interest, Sinead Colton Grant from BNY and David Lefkowitz from UBS.